This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Suddenly silent. The man known for hiking the price of a life-saving medicine refused to answer questions under oath. But can Congress realistically do anything to curb drug price hikes?
Dividend slashed, ConocoPhillips becomes the first energy company to slice its payout. Will others follow?
Open for business, economic sanctions may be lifted, but Western companies still face big obstacles trying to do business in Iran. All that and more tonight on Nightly Business Report for Thursday, February 4th.
Good evening, everyone, and welcome. High drama on Capitol Hill. It involved grinning, mugging for the cameras, insulting tweets, the word imbeciles referring to members of Congress, but no testimony. The normally voluble Martin Shkreli, the former CEO of Turing Pharmaceuticals, refused to testify before a congressional committee today. It was investigating prescription drug price hikes. The man known as pharma's bad boy for raising the price of an older, life-saving antiparasitic drug by 5,000% cited his Fifth Amendment right against self-incrimination. But as Meg Terrell reports from Capitol Hill, Shkreli was anything but silent.
Representatives from Valiant Pharmaceuticals, the FDA, and the Pharmacy Benefits Manager Industry Group were all invited to testify today at a congressional hearing on drug pricing. But the star witness was the infamous Martin Shkreli. His former company, Turing Pharmaceuticals, gained notoriety last year for hiking the price of a 62-year-old drug by more than 5,000%. Shkreli is separately facing federal charges of securities fraud. He managed to steal the show today while not answering any questions.
I intend to follow the advice of my counsel, not yours. On the advice of counsel, I invoke my Fifth Amendment privilege against self-incrimination and respectfully decline to answer your question. On the advice of counsel, I invoke my Fifth Amendment privilege.
But even if Shkreli was silent, his face certainly wasn't.
Like a Ponzi scheme, it appears that Turing may be using revenues from Diaprim to research and identify the next drug it will acquire, and then impose similarly massive price increases on future victims. It's not funny, Mr. Shkreli. People are dying, and they're getting sicker and sicker.
Shkreli's lawyer, Benjamin Brafman, who's defended Michael Jackson, Jay-Z, and other celebrities, attributed Shkreli's responses to nerves.
It's extraordinarily unfair that Turing has been singled out for the type of unfair publicity that they have received. And when all of the facts about Diaprim and Turing are ultimately disclosed, I think everyone will recognize that Mr. Shkreli is not a villain. He's not the bad boy. I think at the end of this story, he is a hero.
Brafman said he's confident Shkreli will be cleared of all criminal charges. His client took to Twitter minutes after leaving the hearing to fire shots back at Congress, saying, quote, "Hard to accept these imbeciles represent the people in our government." Shkreli is due back in court on his federal charges May 3rd.
Meanwhile, the hearing today didn't let all others off the hook. Valiant interim CEO Howard Schiller was also dressed down by several congressmen about price increases his company has taken. He said they've made changes to that strategy and they continue to review it. The FDA was also questioned about how it can speed up its review process for generic drugs with the hope that more competition could help bring down drug prices. And in an election year, this issue is expected to stay front and center. And experts say that Martin Shkreli gives politicians an easy target. For Nightly Business Report, I'm Meg Terrell in Washington.
So how much power does Congress really have when it comes to lowering the cost of prescription drugs? Joining us now to answer this question and others is Craig Garthwaite. He is the assistant professor of strategy at Northwestern University's Kellogg School of Management, where he specializes in healthcare. Craig, welcome. It's nice to have you with us tonight.
Thank you.
I guess that is the question. Does Congress have much power or any power to control or to lower drug prices?
Congress has some power. It's important we sort of split these drug price increases into two broad groups. There's sort of the Turing and the Valiant Pharmaceuticals. These are people who are buying generic drugs, and they're raising the price dramatically and taking advantage of a market imperfection. For those, Congress can commit to allowing the FDA to re-import drugs from England if you have a large price increase. They can sort of speed, as they talked about in the committee, speed the entry of new generics through the FDA. Maybe give fast track authority, let new drugs come onto market, and we can solve that. The other side of the market that we often talk about with high drug prices are innovative new drugs like the cure for hepatitis C or a lot of the oncology products we've seen. And for those, we have to question whether we think the high drug prices are actually bad or if they're giving the proper incentives for the development of new and innovative products.
You know, I guess most Americans would say we want innovation. We think that innovators deserve to be compensated for their breakthroughs, as in the case of Gilead and the Hep C thing. In this case, I think what rankles people is that Mr. Shkreli's company went out and bought a drug that had very little, an old drug dating back to the 1950s, that had very little competition, and saw that and quote took advantage of, as you say, a marketplace imperfection. Have I got that sort of right?
That's exactly the difference. Daraprim is an old drug. It's a critical drug for people who need it, but it has no patent protection. And the only reason we don't see more people entering is that there are only about 10,000 prescriptions a year. And so it's not really profitable for a second company to come in. Given that fact, the Congress could do things like allow the FDA to say that a very large generic price increase is equivalent to a drug shortage, and in a drug shortage, we can re-import drugs from Western Europe, say England or Germany or somewhere like that.
At a lower price.
And that would bring the price back down.
The same drug?
Yeah.
The same drug. Bring British Daraprim over at a much lower price because they get it at a lower price.
Exactly. I want to be clear, though, I'm talking about that only for sort of these
right.
older generic drugs with small patient populations.
You also say that Congress can change the patent length in terms of how long a company can hold a patent on a particular drug if they are the sole supplier of it. Explain that a little bit more for me.
Well, what we're saying is that, all I'm saying is that for the innovative drugs like Gilead's Sovaldi that cured hepatitis C, rather than trying to implement, price controls or trying to determine what's the appropriate price, if Congress does want to sort of decrease the amount of profits that pharmaceutical companies are making, they could look at other tools they have, like the patent length. That's well within their control. Maybe we don't want to have as long of a patent length as we used to have, or as long of a patent length for drugs as we do for software or other areas. That's a fine thing to look at, but we have to be very clear that if we do that, if we lower profits for these drugs, it decreases the incentives at the margin to develop new ones. And I think we all want to have new oncology products like Keytruda that Jimmy Carter took to reduce his cancer, that hepatitis C patients are taking. These are all things we want. And the conversation we should be having is less a focus on price and how much do we want to sacrifice cost for innovation. That's a productive, but perhaps less politically popular conversation.
I'm going to ask you a tough question, but I need a quick answer. How much would allowing Medicare to negotiate the prices of drugs retard the expansion or the rise in drug pricing?
It really wouldn't do much. We require that Medicare cover basically every drug. And because of that, you can negotiate all you want on price as a group, but the pharmaceutical firms know you have to cover their drug in the end. If you want to use Medicare to lower prices, what you have to do is allow them to exclude drugs, and that's going to mean some seniors won't get the drugs that they want.
All right, on that note, Craig, thank you so much for your perspective and shedding some light on what is a top-of-mind topic right now. Craig Garthwaite with Northwestern University's Kellogg School of Management.
Well, there was relative calm, believe it or not, on Wall Street today. Though the session was choppy, the stock swings were noticeable, but they weren't of the magnitude that investors have become accustomed to lately. By the close, the Dow Industrials rose 79 points to 16,416. It had been up as much as 150 at session highs after opening slightly lower. NASDAQ gained 5 and the S&P up a whopping 3. As for oil, prices settled down about 2%.
ConocoPhillips did something many oil companies do not want to do. It slashed its dividend by a lot. In the face of tumbling oil prices, shares fell more than 8% as the energy firm also reported a loss for the quarter. And now the question is which companies might be next. Morgan Brennan takes a look.
ConocoPhillips slashed its quarterly dividend by 2/3 in what CEO Ryan Lance called a, quote, gut-wrenching decision. The largest U.S. independent producer, Conoco is the first major oil company to cut. And while the yield had soared to 8%, the move came faster than many on the street had anticipated. The reason the stock sank in today's trading. At a time when oil majors like ExxonMobil, Chevron, BP, and Royal Dutch Shell continued to defend their dividends, Conoco's move could be seen as a harbinger of more cuts to come if crude stays this low and credit markets tighten. Analysts say it all comes down to the cash pile and whether a company can pay out shareholders without borrowing to do so.
I think it goes back to the point cash is king in this market. And anything you can do to conserve cash and be able to ride this out, the better positioned you're going to be.
Conoco had already dramatically cut capital spending, something it did again today as well. But with crude at $30 a barrel, management felt that wasn't enough to address the shortfall. Some analysts worry Royal Dutch Shell could be next, despite company comments to the contrary, thanks to a portfolio of pricey offshore projects. And Chevron's promise to maintain a payout through 2017 has been questioned as well, though its Gorgon natural gas project should help cash flow next year. But throughout the energy sector, this has become an issue. As equity prices have dropped, dividend yields have jumped, averaging 4% after recently hitting their highest level since at least 2000. According to FactSet, some names that could be ripe for a reset: Williams Companies, which yields a staggering 14%, ONEOK, which yields 10%, and Murphy Oil, which pays out 7%. So while, for now at least, most oil majors may be defending their dividends, analysts warn energy stocks with yields over 6% might best be approached with caution. For Nightly Business Report, I'm Morgan Brennan.
The White House will propose a $10 per barrel oil fee in its 2017 budget. The money collected, if it ever is collected, will be used to invest in clean transportation projects and, if approved, would have been phased in over 5 years. The fee would be paid for by oil companies, but many say the likelihood of it passing a Republican-controlled Congress is slim to none.
After a batch of soft economic data this week, we got more today, including the job market. The number of Americans filing applications for unemployment benefits rose. And as Hampton Pearson reports, there's growing concern among some economists that the labor market is losing momentum.
One day before the Labor Department's January jobs report, more signs of a possible economic slowdown. Planned job cuts surged by 218% last month, according to a leading outplacement firm. Among the 75,000 announced layoffs, more than 22,000 were in retail, where Walmart has announced plans to close 269 stores nationwide. And another 20,000 energy sector jobs will be lost due to slumping oil prices.
These are the highest cuts since last summer, and they're coming primarily, the two big industries are retail, which we often see after the holiday selling season, and then energy.
First-time claims for unemployment increased by 8,000 last week, suggesting some loss of labor market momentum, following reports earlier this week that the overall economy grew just 0.7% in the fourth quarter. Leading economists still expect payrolls to increase by 190,000 in January, with the unemployment rate holding steady at 5%. However, it's far below the December surge that saw 292,000 new hires. At the same time, brand new data show worker productivity declining, and labor costs for employers are increasing, creating some tough choices for businesses.
We have a labor cost problem, and that labor cost problem is for American businesses. And now American businesses can respond in one of two ways. They can try and raise prices, which gives the Fed a problem if they succeed, or their profits get squeezed.
Market watchers may look to tomorrow's jobs data as a possible speed bump to slow down future Fed rate hikes, while most workers will be looking for signs of higher wages. For a Nightly Business Report, I'm Hampton Pearson in Washington.
The weak data have increased the talk of a possible economic recession, and some are looking to the stock market for signs that one may be coming. But is the market a good predictor? Steve Leisman takes a look.
Back in 1966, the eminent economist Paul Samuelson famously quipped that the stock market had predicted 9 of the last 5 recessions. So we went back to see, is that really accurate? How good is the stock market at predicting recessions? We looked at every bear market using information from the financial research firm Bespoke, looked at every bear market in the post-war period, and there have been 13 of them. And they're denoted by the bear clause right there. And you'll see in a second why some of them are red and some of them are white. Now, if we look at the next screen, what you see is these are the recessions. And each one of the red claws here show you that they did predict recession. So what's the record? Samuel said 9 out of 5. That's like shooting 55% from the field. This 13 out of 7 is 53%. So that quip turns out to be pretty good. Now, is there information in there that investors can use? And there actually is. We did a little bit more work on this, and what you see is that the average length of a bear market is 362 days. No recession, in other words, those bear markets that don't predict recessions, they're a little bit longer at 192 days, and the bear markets that do predict recessions are longer, they're 508 days, raising the question as to whether or not the bear markets themselves have a very negative impact and help cause the recessions. And you get a lead time of 253 days. So the lesson from all this is don't panic, but beware the bear. For Nightly Business Report, I'm Steve Leisman.
Still ahead, what are nervous investors to do? Advice from investment professionals to keep your money on track.
Increased volatility, slowing global growth, plunging crude. The issues are familiar. They're nerve-wracking ones to investors, and it's the topic of conversation among the hundreds of investment advisors gathered in Orlando, Florida. Mike Santoli is there talking to some of the men and women who manage your money.
The market's wicked start to 2016 has put a bit of a scare into retail investors, and the volatility is the talk of TD Ameritrade's annual Link Investment Advisor Conference in Orlando. According to an advisor survey unveiled here, 29% say investors are less willing to take risks than they were just 3 months ago, forcing advisors to soothe raw nerves. The anxiety is especially high among investors closer to retirement.
My clients, tend to be closer to my age. And so they've been through 2000 to 2002. They've been through 2008. And so I think their concern is, I know what this feels like. Are we getting ready to have another 2008?
Advisors, too, are cautious. More are skeptical of the U.S. economy's strength than at any time since 2009. But it's not just the markets and the economy that have Main Street investors unnerved.
We'll muddle through until the fall elections, and then once the president is elected, the market likes the certainty, and we'll see the markets go one direction or the other, and hopefully it'll reduce some of the volatility.
Of course, advisors are in the business of helping their clients stick to a long-term plan. So in a way, rough markets are when they can prove their value to investors who might be tempted by less expensive so-called robo-advisors or automated investment services.
2008 and 2009 actually prepared investors and advisors for what we're seeing today. In 2008, I think some advisors got caught a little bit flat-footed, and we saw a lot of communications coming in from clients, where now advisors have the infrastructure built and they recognize we need to be more proactive with our clients to help talk them through these types of situations.
Because when the markets get scary, many investors run the risk of losing sight of their long-term goals. For Nightly Business Report, I'm Mike Santoli in Orlando.
LinkedIn shares tumble in after-hours trading, and that is where we begin tonight's market focus. The company said current quarter profit and revenue will come in below Wall Street estimates. The professional social network cited weakness in some businesses outside of North America. That warning comes despite strong results in its most recent quarter. Shares dropped sharply in after-hours trading, as you can see there. But in the regular session, the stock was fractionally higher to 192.28. Clothing retailer Ralph Lauren posted a decline in sales for its latest quarter, missing expectations. An unseasonably warm winter, a stronger dollar, and fewer North American tourists hurt its holiday sales. The retailer also cut its sales outlook for the current year. That news sent Ralph Lauren's shares down 22% to $89.95. And a similar story over at the retailer Kohl's, which saw its shares fall after cutting its earnings forecast for 2015. The retailer cited poor sales during the holiday season and sluggish demand for winter products. The company is expected to report full fourth quarter results later this month. Kohl's shares fell nearly 19% to $41.51.
Viacom named Philippe Doman as the company's next executive chairman, replacing Sumner Redstone. The decision came during a board meeting today and follows news yesterday that Mr. Redstone had resigned from the same post at CBS. Shares of Viacom gained more than 1% to 45.34. Hasbro and Mattel, two of the world's biggest toy companies, have reportedly held talks about merging. As first reported by Bloomberg, Hasbro approached Mattel late last year, and the companies have held talks on and off since. No comment from either company. Mattel shares up over 1% to 32.29. Hasbro also higher by about 1% to 75.90. Dunkin' Donuts reported better than expected earnings despite declines in same-store sales and traffic at its U.S. locations. The company citing increased competition as the reason for the decline there. Dunkin' Donuts shares soared 6% today to 43.36.
Iran's economic isolation may have ended weeks ago when the nuclear deal was implemented and sanctions were lifted. The country hopes to see $50 billion in foreign investment. But as Kayla Tausche reports, that challenge is getting it there.
Iran is open for business, inking billions in deals in France and Italy following sanctions relief for infrastructure, oil and gas pipelines, and commercial aircraft. The problem, finding a way to get that money from the companies to Iran.
It's the new gold rush. But all businesses will have to be financed somehow, and that's going to have to involve banks.
The deal reached over Iran's nuclear program lifted sanctions on banks outside the United States, but harsh rules still apply to U.S. financial institutions. So any foreign bank that does business in Iran must ensure no part of that transaction touches or gets routed through the account of a U.S. company or citizen for years. There are clear reasons the White House is still cautious of this activity.
Some of it will end up in the hands of the IRGC or of other entities, some of which are labeled terrorist. To some degree, I'm not going to sit here and tell you that every component of that can be prevented.
The banks are also concerned for their reputations.
For banks and financial institutions, which have been targeted by very significant penalty actions in recent years, there's going to be, I think, a very cautious incremental approach.
Those penalties have topped $15 billion in the last decade, mostly from the Department of Justice, enforcing U.S. rules on foreign banks operating here. Former Attorney General Eric Holder warned them of that fact in 2014 while announcing criminal money laundering charges against French bank BNP Paribas.
Banks thinking about conducting business in violation of United States sanctions should think twice before they do so, because the Justice Department will not look the other way.
A recent Treasury memo outlined exactly what non-U.S. persons and companies can do now. They can invest in Iran's natural resources and do business with Iranian nationals not blacklisted by the U.S. government. It also said Iran can issue sovereign debt and credit cards for its citizens. MasterCard CEO Ajay Banga told investors, though, that may take 5 to 10 years.
There has to be a whole change in the sanctions regime that allows companies like us and our competitors and banks to operate freely in Iran. That has yet to be seen.
Some exceptions have been made for trading carpets, pistachios, medical products, and humanitarian aid. The rest of the U.S. economic sanctions are not expected to be relieved until 2023. In the meantime, Iran may be open for business, but many businesses have yet to figure out whether they can be open to Iran. For Nightly Business Report, I'm Kayla Tausche in New York.
Coming up, why this weekend is also game time for one Silicon Valley firm.
Just days from the big game, the city of San Francisco is playing defense, working to prevent a logistical transportation nightmare for fans in the city trying to get to the stadium miles away. But as Jane Wells reports, one company has a solution.
The Super Bowl has come to San Francisco, and not everyone likes it. Protests, construction, security. Traffic is bad on a good day here, and this week around Super Bowl City, at times it's been a nightmare. Google is trying to help, letting the host committee use its employee shuttles for game day fans. And Uber has taken the lead on the Super Bowl of logistics.
There's going to be huge demand, that's for sure.
Longtime Uber driver Ben Amadad hopes to profit from that Sunday. There are over 40,000 Uber drivers in the Bay Area, and for the first time, the company has become an official sponsor of the Super Bowl, paying the host committee an undisclosed amount somewhere south of $500,000.
This is our hometown, and, the Super Bowl is here. 6 years ago, we didn't exist, right?
Uber's Amy Friedlander Hoffman Ubered me to a parking lot a 15-minute walk from Levi's Stadium. This is what the company gets by being an official part of the game. So tell me what we got.
All right, so we have a lot, which today just looks like a parking lot. But for game day, we're going to turn it into really the Uber experience. And so that means a few things. That means we will have hundreds of cars that will be here ready and waiting, and drivers that will be ready and waiting for people.
If I were a Lyft driver, how close could I get to pick someone up?
A lot farther.
I think it's going to be extremely important to have a pickup location.
Amadad said without an official parking lot, security around the stadium Sunday might force fans to walk at least a half hour to find him. But this being San Francisco, nothing corporate ever goes down well. Some Uber drivers are now protesting fare cuts, and they're reportedly vowing to shut down the Super Bowl on Sunday, ironically at the very time when they could make more money because fares will rise due to demand. While some Uber drivers may be unhappy, Uber, the company, has spent Super Bowl week trying to make riders happy, even delivering puppies as a tie-in to the Puppy Bowl. But Sunday will be the real test, as this San Francisco startup turned juggernaut finds out whether it's worth it to play ball with the Super Bowl. For Nightly Business Report, Jane Wells, San Francisco. I hope it's a good game.
I hope it's a good game, too. I think it may be.
I hope so.
We shall see.
I'm not going to ask you who you're rooting for.
Tomorrow.
That for Nightly Business Report, I'm Sue Herrera. Thanks for joining us.
And thanks for me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we'll see you here tomorrow night.